Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you very much for watching the channel, all the comments and subscribers. I greatly appreciate it. This week up, we're going to do Intel as part of a three-part series, Intel, AMD, and NVIDIA. We want to take a look at these chip manufacturers and figure out how much cash flow they make. And if we forecast them going forward, how much we think we can earn if we buy the stock today and hold it for 10 years. So this week up, the monster Intel, one of the biggest in the industry, certainly by revenue and cash flow. We're going to take a look at this beast. They are doing massive investments for growth, so let's figure out what they're worth. Let's get to work. Okay, before we review Intel, let's review the 5 key attributes that we use to value and consider all of the investments on this channel. Number 1, top line revenue growth. We need that to be growing. Number 2, EBITDA, enterprise level earnings need to be growing. Number 3, strong free cash flow. Number 4, low debt. That's less than 3 times debt to EBITDA. And number 5, a well-priced stock. A well-priced stock being I can buy it today with a conservative forecast and beat the market. That's the idea of a well-priced stock. So let's see how Intel stacks up. Behind me, I've got 9 years of historical financial information I've pulled from their 10Ks. The very first column we want to look for is revenue to see if that checks our box. $52.7 billion of top-line revenue growth is grown fairly steadily for the last 9 years at an average annual rate of 5%. Currently, last fiscal year, $79 billion, a hallmark year for them, top earnings for the business. It should also be noted that this year they changed CEOs, have a new leader with a new game plan. He's going to be heavily investing into the fab facilities. We'll cover that in a little bit. EBITDA is $20 billion, has grown to $33 billion with a little bit of a drop off here the last couple years. That's a 6% annual growth rate even after the drop here. This drop is basically from slightly lower gross margins and much increase, if that's a word, higher R&D expense. So I don't expect these margins to remain as they invest more in R&D. I think they're going to have a lower EBITDA margin going forward. But once they start that, they can maintain the growth rate with revenue, with earnings. So I think this drop is kind of a one-time deal, and maybe it'll go up from here. Let's take a look at enterprise value. Enterprise value starts with debt. Now, what have they been doing? Well, they've been borrowing some money over the past 10 years. It's almost a little bit more than doubled over this period of time. That's a 14% increase in debt, which is too high for a 6% growth rate in EBITDA. That's not something we like to see. Actually, that's tripling, by the way. I did the math mentally wrong. That's $13.6 billion to $38 billion. That is a tripling in 10 years on EBITDA that is up 50%. So I don't like that sign is where it's going. I'm hoping that's going to change with the build out of the new facilities. Although if they want to borrow money to go build those, they're going to need to grow debt as well. But we'll see how that adds up. The nice thing is they do have excess cash. They have $2.1 billion of excess cash. It's come down over time as they've kind of used that for share buybacks, for dividends, but it's still there. Market cap is shares outstanding times price, and we're getting $132 billion to $210 billion on a share price. That's actually only a 6% growth over that period of time. Not very good. And the enterprise value, if I add debt and market cap, less cash outstanding, I get the enterprise value. That's the true value of a business. This is $140 billion, $250 billion, $250 billion. So it's been roughly flat for the last 5 years as they've struggled to get under their feet and grow and compete in this market landscape. Debt, I think, is no problem. Looking at these numbers, in terms of debt to EBITDA, it's basically 1. It's been half of 1 for a long period of time. It's come up, but still much less than our 3 times. They can afford a whole lot more leverage than they can afford to go out and borrow money to build the fab facilities that they're going to do. On a valuation metrics, this stock trades between 6.5 and 9 times EBITDA, maybe 9.5 times EBITDA. Over the last 8 years, which is a very cheap multiple for a company that produces such cash and has such a large revenue factor. Even if they're not growing, a 6% growth rate over this time frame is a pretty decent growth rate. And for them to be sitting and a 6 to 9 times multiple is low for this type of business. Now, I will say that the semiconductor industry as a whole trades around 5 to 6 times. So in general, these companies do trade cheaply, mainly because the CAPEX they have to invest in, which is not included in this EBITDA number that we'll cover a bit, but that causes this multiple to be a little lower. But nevertheless, I still think it's fairly cheap. We'll put it into the cash flow model here in a second and see how it stacks up. All right, let's take a look at cash flow. All right, cash flow from operations. The first thing we're going to do is we're going to pick up the $20 billion that they printed in 2013. And they're going to watch it to see what happens. And it's growing, albeit slowly, at a 5% annual growth rate over this time, including this drop-off here, which corresponds to the reduced EBITDA we saw last year. Now, one thing that I want to note is that CAPEX here. This CAPEX has moved up substantially. If you look at this range in here, it's roughly 40% of the, 50 to 40% of this number. So they're making $20 billion in cash flow from operations here. They're putting back 50% of that back into the business as CAPEX. That number has gone up to 60% now. So what they're saying is they're going to invest $160 billion over the next 5 or 10 years, building 2 massive facilities, each of which can hold 8 fabs inside of it. Each fab is $10 billion. 10 billion times 16 fabs is $160 billion that they're going to put into CAPEX, and it's going to fall on this line. And they're going to pay out about $20 billion every single year for quite a long time. Could be 8 years or so. So this ratio here is contracted. So cash flow for us is going to be lower going forward as they invest money into this business. But I do think that once that's invested, the facility starts up and starts producing products. They can sell those products, and I would think that that should lend to higher revenues in the future as they're able to sell the products produced in those factories. I'm hoping that that means higher revenue growth. But let's go forward and see what else they do. Debt payments, you can see they've been borrowing money the last couple years. But overall, this is relatively small compared to the $30 billion of free cash flow they made last year. And that's hard cash money that they made from selling their products. Even though they're not the top chip producer like NVIDIA or AMD, they still make plenty of cash. And their products still sell, and they just recently minted the number one or a new all-time high of revenue for the company despite those headwinds, which I think is very interesting in this landscape with such demand for chips and semiconductors, that a company like this continue to grow with the increasing tide that is the semiconductor industry. So I sum this all up and I get cash flow to the equity holders. That's cash that's available to you and I who buy the business. If I were to put that on a per share basis, dividing it by the share count, I get a cash flow per share, which is the last fiscal year, I'll call it $3, which is very low. And that include, by the way, borrowing money. If I were to zero that out, this number gets even lower, 2.3, which is materially less than what it had been in the past, call it $4. That's much lower. But I do want to show you something that I found that I want to make some interesting comments. What I did is I adjusted the free cash flow per share, and I get $3.40. And I do that by taking cash flow from operations 2021, the CAPEX, and I make adjustments, the $4.2 billion adjustments that I'm going to go through right now. All right, for these $4.2 billion of adjustments, we need to dive into the 10K, the detail behind the cash flow statement. Now, what we always pull is this line, cash provided by operating activities. It's the cash flow from operations, or the CFO that I show in the table. The next one we typically pull is the CAPEX, purchase of property, plant, and equipment. In this case, some additional sale of property, plant, and equipment. These numbers produce the $20 billion that they reinvested. But what I want to point you out to is this section here. It's called changes in assets and liabilities, and it's inside the cash flow from operations section. Generally, we refer to this as working capital. That's basically money that's put into inventory, AR, AP, general cash that's used to run the business. That usually sits in here within the cash flow statement. And what you'll notice is a few very, very large cash outlays. That is reducing this number from what it normally or should have been on a normalized basis. What do I mean by that? Well, accounts receivable. That is a sale that they received, a sale that they made that they haven't received cash from yet. So the sale is booked as income, hence the all-time high revenue, but they didn't get cash for that, so they have to remove the sale from the net income because it didn't come in cash. And what they're trying to tie out is how much cash money came in the door. So that's $2.6 billion of money, revenue that booked that wasn't cash. Well, that's going to come in next period as they pay the vendor, the customers pays their invoice. These were supply contracts that Intel signed. But what you notice is in prior periods, these numbers were much less. So what I can do is I can look at, say this is $1 billion between the two, negative, positive, that's where it kind of oscillates. And then 2.6, well, that's $1.6 billion of cash that I can kind of normalize and put back that I know next year I will get. And that's what we're trying to look for, next year's cash. Also, inventory. Inventory was relatively small historically, $700 million, $1.4 million, and then it jumps here to $2.4 billion. That's another, call it, $1.5 billion. So you've got, this is basically $3 billion of money. Going more quickly, accounts payable, they should have paid this down, so I've removed a little cash here, about $1 billion. And then this number here, which is prepaid supply contracts, that's revenue that they should have, that's expenses that they incurred that they did not pay. They should actually get that cash back. So I reversed that out. And when I add up all of those, I get about $4.2 billion that I add back to the cash flow from operation to kind of normalize it. And when I put that on a per share basis, I get $3.40. I'm going to take that into the future because these changes here are abnormal. And what I want to try to do is get a normal run rate that I can forecast off of and adjust for the one-time basis. All right, so that's what we're going to do when we go forward for cash flow. Let's forecast cash flow and figure out how much we think this stock's going to be worth in a decade. Now, when I read the reports on Intel, everyone's saying that Intel is going to have an earnings drop of about 6 to 8% next year, depending upon what you're looking at, because of increased R&D, because of some litigation issues out there, which is unfortunate, and the reinvestment in this business to grow it. They're going to have to write down assets. They're going to have to invest in new R&D and people. And in general, construction is very expensive and likely to go over budget. So people are hedging their bets and they're saying Intel is going to have a weaker year next year. And then it's going to flatten, and then it should grow back as these facilities come back online or come online with new facilities. They should be able to pick up revenue and grow it. And the 6% is basically what they've been growing historically, EBITDA and cash flow at, and I'm picking it up. I think they could actually beat these numbers. If they're adding so much extra capacity and the market remains, they should be able to grow revenue and earnings faster than what they have historically, having put in, at this point in the model, they'd be kind of halfway through this $120 billion. So I think in the end here, 10 years from now, this cash flow could be substantially higher than what it is once all the facilities come online, they have customers, and they're selling those products. But that's too much for me. I don't want to bet on it. So I'm going to say they return to kind of a normal rate. And what does that get me? That gets $5.15 out 10 years. I apply a 6% yield to that. I get $85 a share. All right, so EBITDA, the other way we forecast is just looking at enterprise value EBITDA. So here, I'm doing the same thing. I'm haircutting EBITDA next year. I think they're going to come down again. Higher R&D costs, construction costs, so on and so forth. So I'm bringing the estimate down 8%. Then I'm going to levelize it at 8. That's going to be at 0. And I think they will continue to grow long term. This whole industry is growing. I think they're going to ride that wave, and I think they're going to get another 6% out long term, targeting about $50 billion out 10 years for earnings. I give that a 9 handle. I think after they expand their capacity, there'll be a much bigger footprint. They deserve a larger multiple than the 8 to 7 times they're trading at currently. That gives me $462 billion of enterprise value, less some debt, plus some debt, less some cash. I get market cap of $400 billion. Divided by the shares, I get $99.94 per share. So let's see what Intel's trading at today. Now, Intel, as of this video, is trading at $47 a share, and I can buy as much share as I want at $47. If I think out 10 years, it could range between $85 and $99 a share. I'll call it $92, and let's see what that looks like as an IRR. So if we drop that into our IRR model, I've got a string of cash flows out the next 10 years, which, by the way, is already net of a $20 billion investment that they need to make. So this is cash flow after having made the investment into the facilities every single year for the next, call it 6 years, that the 6 to 8 years that they need to make. After that, if I were to normalize this $5, bringing CAPEX back down to what their run rate was prior to the $20 billion, let me show you. So remember I said earlier that they were reinvesting about 40%, 40 to 50% of the money, and then this is like 60 to 70%. Well, that extra delta, the 10%, if I were to put that back in, because they no longer need to make this big investment, bring that back down, that cash flow goes to the equity owners, and that means this number here would be much higher than it currently is. So I think that's a hedge. I think there's more upside there. But what this model does produce is a 15% IRR, which I think is a pretty decent return given the market we're currently in, where the vast majority of stocks are still very expensive, and you have the threat of now global war. You've got inflation running, the possibility of money printing if the economy cools off too quickly, and the Fed's looking to raise interest rates, which is going to hurt reinvestment, long-term investments, and any company that's got a lot of debt on it. So I think this is really interesting. I'm going to continue to give it a decent rating. Let's review our 5 key factors. Number 1, top-line revenue growth. Yes, it's growing. Number 2, earnings growth. Despite the drop next year that's forecast, we do think they'll continue to grow and have plenty of customers for the products they make. So we're going to check the box. Cash flow, strong cash flow, absolutely. Low debt, yes. And well-priced, yes, it is. If it's producing a 15% IRR, given this case, we think it's a decent risk-adjusted return, so we will give it a good. Now, if you want to see how that is distributed, should the price go up more to 52, 57, 60, the return drops off and I would not be a buyer. But if it's in this sub-50 range and you're getting mid to high double digits, mid to high teens, I think that's a very attractive risk-reward basis for a stock like this over the long term. As they build these facilities, I think they're going to cement themselves as a core manufacturer of semiconductors, which is going to be in our society forever. And that kind of installed capacity is a tremendous moat that any other party looking to compete would have to invest hundreds of billions of dollars and spend a decade doing. Once they complete it, I think they're going to be in a very good position to demand a price that they want. So that's my review on Intel. I want to remind you that I do teach a course. If you liked what you see here, check out my course at cashflowinvestingpro.com. I give you the Excel template we just walked through. I go through Apple and evaluate it for you. I show you how to pull the 10Ks, to fill in the EBITDA, the cash flow, how to build a forecast, and how to think about a cash flow-based portfolio that's going to help grow your wealth for years to come. Definitely check out Cashflow Investing Pro. You can also sign up for the Cashflow Club, where I produce one-pagers. We've got a team of analysts now that are cranking out one-pagers and all kinds of different securities, far more than we can do here at the channel on a weekly basis. But what you get is you get 10 years of financial information. You get a write-up summary of where we think the stocks can go, and you get the 5 key factors summarized right off the side to give you an idea of the valuations. Definitely check that out at cashflowinvestingpro.com. Again, I want to thank you for watching the Intel video. Up next, we're going to do AMD and we're going to do NVIDIA, see how those guys stack up. If you want to see other videos, they're going to pop up right about now. Check out other value-based videos. Thank you very much for the time. I really appreciate it. And if you like this video, give it a like, give it a thumbs up, and hopefully subscribe. Really appreciate the time. Thank you very much. Bye-bye.